other income. So, as it says, gross income includes all income from whatever source derived, unless they make an exception to it, right? So, all income. So, it's very broad. You can assume that everything is taxable. Pretty much is, unless they say it isn't. So, jury duty pay is taxable. So, if you go and serve on jury duty, you have to pay tax on that money. You report it under other income. What oftentimes happens, though, is your employer will, you give the check to your employer and they pay you for the day. Like I think most employers pay if you're on jury duty. So, but if you receive it, then you do have to report it. It's very small. So if, chances are it's so small that there's not going to be like a 1099 that you receive for it unless you're on a jury that meets for a very long period of time. Employees that receive a prize or award is included in the W-2 income. So any prizes or awards received from other sources are taxable as other income unless specifically excluded. So I think we pointed out on day one, or when we were looking at the tax return, that the Olympic medals are listed as taxable income. So that would be under prizes and awards. But if there's a prize and award that's not an Olympic medal, that would still have to be listed on the tax return as other income. It would usually, if it's more than $600, it would show up on a 1099. It would not be subject to Social Security or Medicare tax because that's not earned income. But like, for example, prizes, you go to the casino and you win a prize, that actually shows up on a W-2G form, not a 1099, but that is taxable. It's not subject to Social Security or Medicare tax, but that is taxable. You go on The Price is Right and you win a console TV. Again, that's taxable. Even if it's not cash, that is going to be taxable. Forgiveness of debt is taxable. You are economically better off if somebody forgives a debt. So if you have a debt, and most often this happens like with credit cards or other types of like consumer debt, if you are able to negotiate out of a debt, that is taxable income because, like I said, you have become financially better off. Yeah.
Does that include like student loan forgiveness?
So student loan forgiveness was under a different category. I think they excluded it from this. There were certain other ones like during, was it during COVID or during the financial crisis in 2008? Like if you had I think it was during the mortgage crisis in 2008. So if you had your home debt forgiven, because there were some individuals who had some home debt forgiven just because of all of that mess, that as well was excluded. It's not anymore, but those were like particular circumstances where you would have that forgiven. Now, I don't know. I mean, the student debt forgiveness is no longer. And I don't know exactly for 2025 what those rules would be. So as they mention here, they don't mention it here. But I think it was like they had a special carve out to make it not taxable. But if it's another type of debt, so like say a credit card, that sort of thing, that would generally be taxable. The only exception would be if it was during bankruptcy or if the taxpayer is considered to be insolvent immediately before the debt is forgiven. Insolvent simply means that your liabilities exceed your assets. You have negative equity. So, if before the debt was forgiven, you owed $100,000 in total debts, but you had $80,000 of assets, you would be considered insolvent. That requires, I would do that sometimes for clients. I would put together insolvency. It's kind of an involved process that you have to go through and put together a financial statement for them to provide to the IRS to try and get out of. So that would be one exception to the taxability of it. Insurance proceeds. So insurance proceeds up to the adjusted basis of the property immediately before the damage would not be taxable. But if you receive insurance proceeds that exceed the value of the property, then the amount that exceeds the value of the property immediately before the damage would be considered taxable. So if your home burns down in a fire and it was worth $200,000 before the fire, you get a check for $250,000. $50,000 is going to be considered taxable income because you're economically better off by $50,000. So that's what it's going to be taxable. If you got a check for $20,000 or $200,000, none of it's going to be taxable. So they take into account the value of that property before the damage. This does not include life insurance or health insurance. Okay, so those are separate issues. We'll talk a little bit about life insurance here in the next section, where we cover items that are excluded from taxable income. Other questions?